It's time now for today's strategy session. The S&P 500 has been stuck in a narrow trading range, with the benchmark index not entering oversold or overbought territory since July. However, our next guest warning of a potential 10% correction looming. We want to bring in Barry Bannister, Stifel Chief Equity Strategist. Barry, it's great to see you. We are looking at NVIDIA offering maybe some relief to the markets here this morning, but it doesn't sound like you think it's going to last. Why?
Well, the market lives for easy interest rates. We do think the Fed will cut to 4.0% mid-year, but there could be a hawkish hold. In other words, with inflation stuck closer to 2.75% on what's called the core PCE deflator, the number that the Fed watches very closely, it's very hard to justify too many cuts. I mean, if you look at the real interest rate, the rate after inflation, the middle value, the median, the last 50 years, short-term money should give you 1.21%. And so if you're looking at about 2.75 to 2.8, add 1.21%, you see how the Fed really can't go below 4. So as we get through the year, I think the Fed will probably take back or react slowly to a slowing economy, that second rate cut.
What are the top factors that you think would drive that activity from the Fed?
Well, the stickiness of inflation and the economy decelerating then brings the question of what is the Fed's reaction. It's called the reaction function. I think the Fed will be a little slower. Stagflation, even mild stagflation, which is a little more stagnant economy and sticky inflation, could cause a pullback in the consumers. They'll decelerate from the recent 4% spending rate. And jobs are becoming a little harder to find. And they have spent themselves up quite a bit. We wouldn't be surprised to see the consumers pull back. You're not going to get anything from government or net exports with the strong dollar. So the GDP numbers will really fall off as you get into the back half of the year. And again, the Fed's reaction to that, with inflation still very sticky, is going to be the tell.
Barry, I'm curious how you're looking at the moves that we've seen in the bond market. You have the 10-year yield right around 4.3, substantially lower than that 4.5 range that we were trading around now for quite some time. What does that signal to you, just in terms of what is being priced in, and ultimately how this will likely play out for equities?
Okay, let's say, like I said, the appropriate short-term rate is about 4. Now they can go easier than that, and we have had, Jay Powell has been, believe it or not, one of the more easy Fed chairs of the last 3. I mean, Greenspan in the back half of the 90s in the tech bubble had a much higher real interest rate, or a rate after inflation, and Bernanke in 2005, 6 into 7 actually got to a much higher real interest rate. So Powell is an easy peasy chair, no question in my mind. And when you had the long end, so you've got the short end around 4 is a fair value. The long end was 4.8. Markets felt that. They went sideways. It pulled back to 4.3. That 50 basis point drop in the 10-year yield has really been keeping us from dropping. And the question then becomes, economy decelerates, inflation sticky, what's the Fed going to do? How does the bond market react? And this is all going to play out over the year.
And so then on the equity side of the trade, what is the defensive play that investors could orchestrate with their portfolio right now?
Well, ever since the NVIDIA quarter 2 years ago, everyone's been on the AI trade. And I understand, keeping a position, even I do, keep a position barbelled into tech to benefit from the mania that we're in. But you're at a very, very high multiple of earnings. Your more sophisticated valuation methods like enterprise value based against economic profit or return on capital above cost of capital, they also indicate, very much like the late 1990s, a level of enthusiasm among investors that it's dangerous. So what you do is you barbell that, or you are defensive against that with things like healthcare, staples, utilities, which are not doing well today. So you buy on the dip.
And so if you are dip buying, are those the top dip buying opportunities, those that are on the defensive barbell or side of the barbell? Or is it some of the riskier assets that might also be seeing a significant pullback here and have already kind of run high on valuation?
Well, like I said, the first 6, maybe 9 months of the year will probably end up being in a trading range. And it has been year to date a trading range. But then you'll have a sharp fallback, particularly your late third, early fourth quarter, typical almost seasonal weakness in the stock market. So it could be just a very wobbly year with a pullback in the market that would benefit defensives because they would hold their value. Their price earnings multiples, by and large, are not as bad, and their earnings are decent. So, in a sense, they would just be defense against a more offensive strategy that is really fully valued here.
All right, Barry, always great to talk to you. Thanks so much for joining us here this morning. Barry Bannister of Stifel.